Big question, how do you decide on the best SPV remortgage product for your buy-to-let? Now you might be thinking, I know, I'm just gonna take the lowest 2-year fixed rate. Sounds good, right? Well, here's the thing, you could be making a big mistake. If you're new to my channel, hi, I'm Jonathan. I've been working with property investors for the last 6 years at my mortgage brokerage, SPV Mortgages, helping them to secure the best limited company mortgage deals based upon their specific circumstances. And my channel is all about sharing my experiences that I have with them, with you. I'm going to cover 3 important points with you: the cost of refinancing, equity release, and returns. So most new investors who have recently bought a property via an SPV miss a very important point, which is the cost of refinancing. Now, unlike residential mortgages where there are hundreds of lenders fighting for your business and there are plenty of freebies such like valuations and legal fees, in the SPV space, it's the complete reverse. There's not as many lenders, there's not as much competition, and you should expect to pay for valuation, legal fees, as well as independent legal advice and personal guarantees every time you move from one lender to another. So let's break this down. Valuation fees can be as little as £200 to thousands, depending on the value and the type of property. Legal fees are between £1 and £2 grand. Independent legal advice and personal guarantees per director are around £150 plus VAT. So all in all, you're looking at around £3 grand for a property worth £300,000 with 2 directors every single time you're looking to refinance. So we know a property worth around £300,000 is going to cost you around £3 grand to refinance. So if you think that in 2 years' time interest rates are going to drop 1%, and let's just say that the mortgage on this property is £200,000, a 1% reduction is going to save you £2 grand in year 1 and then £2 grand in year 2. But remember, it's cost you £3,000 in costs to refinance. So you're up £1 grand. That's not taking into account the product fee that the new lender is going to charge for the product that you've just taken out. All in all, if interest rates drop 1%, you've got a mortgage balance of 200, it's cost you £3,000 in upfront fees. Is it actually worth taking out a 2-year deal? So the number one reason why people invest in property is wealth creation. And for most, what that means is releasing equity from one property to invest in the other to build your property business. Over time, you can increase the number of properties. Obviously, those properties will increase in capital appreciation as well, given a good amount of time. So the question is, how do you structure your mortgages to take advantage of that particular strategy? So this ties into 3 things: house price inflation, interest rates, and adding value. So let's break all of those down. Now, if you think that the value of a property is going to be increasing, say, 3% in year 1 and 3% in year 2, and that 3% is sufficient enough for you to cover the refinancing costs and release enough equity in order for you to expand your portfolio, then a short-term rate would be appropriate. However, what happens if the property doesn't increase sufficiently enough in the 2 years in order for you to achieve those objectives? So in this case, what you want to be thinking about is, can you add value to the property? Can you add an extension? Can you add a couple of bedrooms? Can you expand the size of the property? Can you carry out all of these works under permitted development? And will that value add then increase the amount of equity that you've built in the property in order for you to then release that equity to expand your portfolio moving forwards? If that is the case, and if that's something that you are intending to do, then perhaps a short-term fixed rate would be more appropriate than a long-term fixed rate, because you can get access to that equity a lot quicker. Let's talk about interest rates now. So interest rate reductions, we don't know how far interest rate reductions are going to occur. We don't know when they're going to occur. We don't know if they're going to occur. So from my opinion, if you're looking to expand your portfolio via equity release from the property that you've just bought, I wouldn't take into account interest rates too much. Right now, there's a lot of uncertainty in the market. No one really knows where interest rates are going. To bank on an interest rate reduction of say 1 or 2% in the next 2 years would be crazy. Don't obviously do that. Think about the natural progression of capital appreciation over that time, tie into any value add to the property, and then look at the suitable product that will allow you to equity release within that period of time. So product pricing is super important, and I see a lot of investors actually missing this. Now, product pricing in the SPV space is very, very different to that of the residential space. In the residential space, typically you're going to be charged around £1,000 for the product fee. But in the SPV space, because of the way these lenders are funded, the product fees can be as high as 8%. Now, to put that into context, if you're borrowing £100,000, the product fee is going to be £8,000. The benefit of a product with a high fee is that you have a low interest rate, which maximizes obviously the net profit. But the way to look at it is to think over a given period of time, say 2 or 5 years, that fee should be absorbed via capital appreciation. But there's two other things to think about. So one, obviously you increase the net return from the property, which then increases cash flow, which is great. But two, you're adding more debt onto the loan, which means ultimately when you come to refinance in 2 or 5 years, there's less equity that you can pull out to expand your portfolio. Let's flip that on its head. You've taken out a product with a high product fee, which is maximizing net cash flow. That means that you can pay for more stuff monthly. And let's just say that you bought the property, you've taken out some personal credit to renovate the property, update it, modernize it, bring it to a higher standard, all those sorts of things. If you use personal credit to do that, like a credit card or a personal loan, with the additional amount of cash flow coming through, because obviously you've taken a low interest rate, you can use that cash in order to pay the credit. Now, the other thing as well is, if you take out a product with a high product fee, the product fee via an SPV is a legitimate business expense. Therefore, you're mitigating your tax liability moving forward. So, in other words, depending on what it is that you're looking to do, a high product fee, low interest rate product could be suitable for you, dependent on your overall objectives. So if you're an experienced landlord, you've got a few properties in the background, but you're looking to take your property business to the next level, watch this video.